Welcome to Capital Insights. To suggest that we're in a globalized financial market and economy these days is very much an understatement. Globalization has been an accelerating trend really over the last 2 to 3 decades. And today we find ourselves in a world that's interconnected. We've talked about this many times. Nothing happens in isolation anymore. Nothing on a global basis. Actions cause reactions, etc. We need to remember that as we act to make prudent and intelligent investment decisions over time. Today, I'd like to focus on the importance of currencies, relative currency movements. You know the major currencies, the US dollar, the yen, the euro. Many other currencies exist. Within this construct of a globalized economy and globalized financial markets, currencies take on a very, very meaningful importance. So I'd like to talk about and look at and review a couple of examples of what we're seeing today, how that impacts our decision making, really all with the goal of impressing upon you the fact that analyzing, anticipating, and understanding how currencies move is very important in terms of anticipating asset prices and how markets and real economies react. The maybe tough part is that the rules regarding currency movements change over time. Trends, how currencies move and asset prices reflect, can stay in place for a while, but they're never constants over very, very long periods of time. They do change. Basically, strong currencies attract global capital. We've seen a little bit of this over the last few years. The foreign buying of U.S. residential real estate, the movement of global capital coming to the United States and U.S. dollar markets, all part of the movement of not only global capital, but how currencies impact that too. So let's take a look at some examples of what we're seeing now, some examples of currency movements that have caused us to make some investment decisions, and just again, examples of how meaningful currencies can be in investment outcomes over time. Let's start with taking a look at the euro. You may know that over the last 2 to 3 months, the euro has dropped about 10% relative to foreign currencies. The fact is, and it's not really a fun fact, the economy is slowing in Europe, deflation is a reality, and the currency is starting to reflect that. So in this first chart we're looking at here, the data in the black line is the euro itself, and the red line is what's called the FEZ. It's an ETF that is called the Euro Stoxx 50. In English, it's the 50 largest stocks in Europe. You know who these are: Nestle, Unilever, etc. But what's important about this chart is that as the euro started to decline relative to foreign currencies, so did these European stocks. Even though I'm not showing you the chart, a large company like Nestle has lost close to 10% of its value over the last few months. Did Nestle's earnings all of a sudden fall 10%? No. Did their revenues, sales, drop 10%? Not at all. In fact, very little's changed for Nestle over the last 2 months. But what has changed is that the currency it's priced in relative to the dollar has fallen 10%, and it's taken that stock price with it. Again, nothing to do with the company, but everything to do with the currency. And in this chart we looked at a minute ago, again, all of the European stock market, the large European stocks, have come down very much in sympathy with that currency itself. So again, over the short term, it wasn't really fundamentals that moved that market. It was a relative currency movement. And again, we need to remember, when we see things like this, it means that global capital potentially will shy away from a weak currency and come to a stronger currency. Is that what's happened in Europe over the past few months? Indeed, that's exactly what's happened. But again, it points out the importance of currency movements in short-term asset price movements. It's not always about the asset. It can very much be about the currency. As I mentioned a minute ago, the rules aren't necessarily uniform across markets. Let's take a look at another market, major market, Japan. The second chart we're looking at right now is the Japanese yen relative to the Japanese Nikkei itself. And what you're seeing here is something completely opposite of what you saw with the euro and the European securities, the large European companies. What we're seeing in this chart is that as the yen has fallen over time, the Nikkei actually went higher. Why? Why would that be? Well, the yen has a very special relationship to global currencies. You may remember the term the yen carry trade. It was popularized back in the early part of the last decade, but this is what it was really all about. Global investors were able to borrow in yen and buy alternative assets. Why would they want to do something like that? Well, they would want to do something like that if they believed the value of the yen was going to fall. So in essence, borrow in yen today, the value of the yen declines, and you actually owe less back than when you borrowed. The yen carry trade. That's exactly what it was. So in today's world, in this chart that we were looking at a minute ago, it showed us that as the yen came down, the Nikkei actually went up. That was happening because, again, it allowed investors, foreign investors, to borrow the yen, pay it back later as it got weaker and cheaper, and invest that money in the Nikkei, invest that money in stocks. Let's look at one other chart, and that is the yen relative to the S&P. Again, we're in a globalized world. This wasn't all about investors borrowing in yen to buy Japanese stocks, but also to buy US stocks. Even though we're not looking at the chart, to buy European stocks, to buy stocks and assets of different countries, different currencies that would be stronger than the yen. Again, it's a relationship that's been in place now for a little while, probably isn't going to change anytime soon, but absolutely impacts currency impacting the movement of asset prices themselves. Again, we just need to understand how these individual currencies can cause reactions in asset prices. Lastly, one last example. You may know that recently the price of oil has come down pretty significantly, about 20%. We don't see that very often, and it's come down over a very short space of time. So let's look at one last relationship here that is the US dollar relative to oil. And you'll see something very interesting. Recently, the US dollar has rallied during this exact time that oil has come down. In other words, the currency goes up and the commodity price goes down. Why would that happen? You may know that internationally, oil is priced in US dollars. When a foreign entity wants to buy oil, the first thing they need to do is to buy US dollars. Then they can buy the oil that's priced in dollars globally. So let's think about if we were producers of oil, but we were in the Middle East. We weren't in the United States. Our home currency isn't the dollar. Our home currency may be the dinar. Our home currency may be one of the Middle Eastern currencies. Well, think of this. Oil is priced in dollars globally. The dollar just went up X%. That means that you, as a foreign producer of oil, just increase your revenues and earnings by X%. And nothing changed in your operations except the value of the dollar globally, a value of a currency, impacted your earnings. So it gave you an automatic increase in your earnings. All you had to do was hold your prices down and potentially sell even more oil. So again, currencies not only impact real economies, but they impact financial markets vis-a-vis these global flows of capital, vis-a-vis how they impact individual asset prices themselves. I could show you example after example after example, but I think you get the picture and you understand the meaning of how important relative currency movements can be to outcomes not only in commodity markets, in financial markets like stocks, but in real economies also. So we need to really make sure that we understand how individual currencies impact asset classes, and we need to anticipate as we move forward. A few last comments today, if you don't mind. We talked very much about how currencies impact asset prices over the last few minutes, but we also need to remember that currencies impact the fundamentals of individual companies too. Example, Microsoft, very large global corporation. About 50% of Microsoft's sales, their revenues, come from non-dollar areas. Europe is a huge market for Microsoft. Asia, same kind of a deal. So when the euro declines relative to the dollar, the currencies, the earnings of Microsoft in euros is declining. As they translate that back into dollars, that's lesser earnings for them. So even though very strong currencies can attract capital, and that's what we've seen with the US dollar of the recent past, it can also impact the earnings of multinational corporations. And one of the reasons we really wanted to focus on this today and bring this up, and it relates to the last chart I want to show you right now, and that's a long-term chart of the US dollar. You may have heard this over the past. There's been a lot of people who are running around saying, oh, the Fed's printing all this money and the US is borrowing all this money. The dollar's going to zero. It's going to just blow up and it's going to be horrible. Well, what this chart is showing us is that the dollar is trying to move higher out of a very, very, very long-term base. I've drawn a little line in this chart. In technical terms, it's a declining tops line, it's called. But the dollar's recently broken above what is almost a 10-year declining tops line in price. For the chartists of the world, or the technicians of the world, what this would suggest to them is that the dollar may move much higher. And when we look at the fundamental reality of global economies, we're thinking exactly the same thing. But we're thinking about it in fundamental terms. It's absolutely clear right now that Japan is very near recession, Europe is very near recession, and it's the same with China. There's a slowdown there that's very, very, very meaningful. It just so happens that even though we have very weak growth in the United States, growth in the United States is really leading all of the developed economies globally in terms of strength. So what that really means is more money is going to be attracted to that relatively strong economy relative to the totality of the global economies that are out there now. So what's that capital being attracted to? It's being attracted to the US dollar. As we move forward, we anticipate, and again, we need to assess as we go forward, there's no guarantees in this world, but we're anticipating a higher dollar over the next year. And we're taking actions, and have already taken actions, in portfolios to reflect that belief that that's going to go higher over time. Where all of this leads us, only the markets know right now, but we wanted to at least be able to express how meaningful the analysis and anticipation of currency movements have become to investment management and decision making. It's accelerated over the last X years as we've become a globalized economy. There's no turning back at the current time. We're not going to break apart into our own respective economies globally. So again, very important as we move forward. We absolutely, not only now, but will continue to integrate currency analysis and review as we move forward across all of our decision making. We very much appreciate your time in being with us. On behalf of the entire team at Capital Planning Advisors, thank you so much. We'll see you very, very soon. I'm Brian Pretti.